Even before 2020, non-financial corporate debt was at historical highs, with companies relying on increasing amounts of high-risk credit against their earnings. This led to fragility in companies and the financial system, squeezing workers and communities and making society, investors, and lenders vulnerable to even a small downturn. When COVID-19 hit, we were all woefully unprepared and lacking resiliency. Building back better from COVID-19 cannot rely on the same risky investment structures that got us here. So how did we get here? High-risk debt is often linked to private equity firms, which buy companies on behalf of their investors, such as pension funds. Many, though not all, use significant debt to generate returns. High corporate debt burdens leave little room for companies to pay quality wages and benefits, and often involve asset stripping, such as the sale and leaseback of real estate. Particularly given low interest rates, this leveraged buyout strategy, as it is called, might help institutional investors meet their target returns. For pension funds, this means paying beneficiaries' pensions. However, even slight drops in profitability can mean bankruptcy for the companies. Obviously not good for workers, and certainly not for our society and the economy if this happens to many companies. In the US, the number of private equity-owned companies jumped over 375% since 2000 to around 8,000 today, while the number of public companies shrunk to nearly half of those now backed by private equity. The industry supports an estimated 5% of America's GDP, roughly the size of Indonesia, and is responsible for a significant share of the US workforce. With over $3 trillion in assets under management and over $1 trillion not yet invested in companies, the industry continues to grow. Private equity executives make some of the highest compensation of any industry. Bloomberg Businessweek notes, there are more private equity managers who make at least $100 million annually than investment bankers, top financial executives, and professional athletes combined. Meanwhile, workers in portfolio companies invest significant parts of their lives, sometimes putting their health and safety at risk, without building any wealth of their own. Additional issues of concern about private equity are lack of transparency and reporting requirements to the public, lobbying and political spend, investment dynamics that make essential goods and services to the public, like healthcare, elderly care, housing, and infrastructure such as water, unaffordable or of poor quality, and how funds and investments are often structured for tax avoidance. Nonetheless, significant leverage is also a problem in public companies, helping them buy back their stock, pay dividends to investors, and fund mergers and acquisitions, activities which have been noted to contribute to consolidation of wealth and corporate concentration. All of this erodes the economy for all stakeholders and even financial stability for investors. Not a great place to be. So, how do we build back better? At the Predistribution Initiative, we believe that even as institutional investors look to private markets for returns, they also have a strong opportunity to invest in ways that benefit all stakeholders. However, we need to increase focus on how investments are structured and rethink investment team incentives so they do not encourage fragile corporate structures. Since private equity firms often take controlling positions in portfolio companies, the industry is actually uniquely positioned to explore alternative and more regenerative investment structures, together with their investors, that can both help the investors meet their required rates of return and compensate stakeholders, such as workers, for the value they create and the risk they take. We invite you to join us in rethinking what these changes could look like. Visit our website and watch our next video to learn more and get involved.